The proof is in the history. Bitcoin is one of the hardest forms of money. But why would we ever change that hardest form of money into something softer? Why would we ever sell Bitcoin? The Bitcoin maximalists say exactly that. The best time to buy Bitcoin is always, the best time to sell Bitcoin is never. But I think this is only true for two types of people. It's true for the individual that doesn't have much to lose. If your net worth is only 1 or 2 months of your salary, then it's okay if you're losing 50 or 60% in a bear market. You can catch up very quickly just by saving for a bit. The statement is also true for the ultra rich people. So the people that have, say, 100 years worth of expenses. Even if they fall down by 50% in their net worth, it doesn't have any material impact on their daily lives. Money truly becomes just a number on a screen and it doesn't have any impact whatsoever. But is it really true that the best time to sell Bitcoin is never, with that volatility for everybody in between? Let's say you worked for a while, for several years, you have saved up a lot of money, you put this into Bitcoin, into the S&P 500, etc. If you now were to swap all of your funds into Bitcoin and you are, say, at 5 years of income in wealth, and then those 5 years in a bear market get decimated to only 1 year, and you have waited all of those years, you've worked all of those years to accumulate that wealth, that will be really hard. For Michael Saylor, Bitcoin is just a number on a screen. It doesn't matter how many billions he owns. And for the college student, it's the same thing. It doesn't really matter how much Bitcoin falls, because a drop, again, doesn't impact long-term life outcomes in any way. Unfortunately, the rest, so the middle, they have to reduce their expected returns just to reduce volatility as well. Volatility does matter. We don't want to fall from 5 years of wealth to only 1 year of wealth and then get very far away from potential retirement. And so we all know about those bear markets, the 85% drop after Mt. Gox and Silk Road, the 84% crash after the ICO boom, and the 76% crash with Terra Luna and FTX. Now this video is about how to ride those waves properly and how to diversify in a smart way so that we still have very high long-term expected returns, but at the same time we don't drop in our wealth by 70 or 80% temporarily. Now most people, when they think of diversification, they might consider not just buying Bitcoin but other altcoins as well. But the issue is that altcoins move in the same direction as Bitcoin most of the time. So everything is going down on the same day, everything is going up in the same week. So really, we have so much correlation across crypto that we can't really diversify. We need to achieve diversification by buying things that have little correlation. So we want to reduce our exposure to Bitcoin at particular points in time by buying things that don't always move in the same direction. Now have a look at this long-term Bitcoin chart and compare this with the Nasdaq 100. Unfortunately, especially in recent years, we tended to see more and more correlation between the two. So when the Nasdaq 100 went down, Bitcoin went down as well. When Bitcoin recovered, the Nasdaq 100 recovered as well. What we see here at the bottom in white, that's the correlation coefficient. So when that's close to 1, the two assets move in the same direction at the same time. When it's close to -1, the two assets move in opposite directions at the same time. And so since the middle of 2020, we saw the two assets, so technology stocks and Bitcoin, moving in similar directions for the most part. So really, technology stocks also don't help with reducing risk. But have a look at this now. This is Bitcoin again at the top, and at the bottom, we see the gold price. Check out the correlation coefficient here. Isn't that much nicer? This is oscillating between -1 and +1. So Bitcoin and gold is not that highly correlated. We can diversify risk away by buying gold and Bitcoin. And so as our net worth grows, as we move from 1 year of income in net worth to 2 years, to 3, to 4, to 5, we want to have gradually less and less exposure to Bitcoin. Once we have 20 years of expenses in net worth, then we can call ourselves retired, because then only 5% of real return, so passive investing across various asset classes without any rebalancing, that then already leads to all the expenses being covered. So 5% on 20 years of expenses means 1 year of expenses every single year. We are retired. So moving from 5 years to 1 year is a problem. Moving from 10 years to 2 years is a problem. But moving from 100 years to 20 years isn't really a problem. We stay retired. Now here's a chart you've probably never seen before. This is Bitcoin measured in gold. So we now divide the Bitcoin price by the gold price. In 2016, we saw Bitcoin for the very first time being more expensive than 1 ounce of gold. When Bitcoin then hit 20K, so at the end of 2017, 1 BTC was worth 15 ounces of gold. But have a look at this. In the last 4 years, Bitcoin did not outperform gold. So we hit our 60 to 70K per BTC at those two tops. Then we had the Terra Luna and FTX collapse with the subsequent recovery. And still, even with the recent 70K in Bitcoin over here, or recently with our 100K, we have not yet outgrown gold. I do believe that long-term Bitcoin will continue to grow faster than gold, but it is a long-term bet. This is a bet over 5 and 10 years, not just over 1 or 2. There is still enough volatility in the price. And again, that volatility justifies to rebalance the portfolio, that there are indeed times where it might make sense to sell the hardest of the assets, to sell some Bitcoin. And there are several useful models. For example, this is the realized hodl ratio. This looks at the trading activity for people that hold Bitcoin for 1 to 2 years versus the people that hold Bitcoin only for 1 to 2 weeks. So when this is high, there's a lot of short-term investments in the market. When this is low, only the long-term holders are trading Bitcoin. So you can see how much attention is there currently on the asset class. Is the market rather heated or is it rather cheap? It obviously makes sense to buy when we are in the green zone. When does it make sense to sell? It's hard to say when the exact top is, right? It seems like those tops tended to be lower and lower with each cycle, but maybe a gradual approach makes sense. As we get closer and closer to the red zone, we might rebalance and own less and less. At the bottom here, we might have 70% of our net worth in Bitcoin. At the middle point, maybe only half of our net worth. At the top, close to the top, maybe only 30% is in Bitcoin, and in the red area, 20 or 10%. In the end, the massive volatility of Bitcoin, so this 60, 70, 80% drops, they come from people taking profit. They come from people, from the long-term holders that take advantage of 5, 6, 7, 8x return. Think about it this way. Let's say you heard about Bitcoin, you don't know much about it yet, and so you're allocating a little bit of your net worth towards the asset class. Let's say 10%. And let's say you are very lucky, you bought at very low prices. Then Bitcoin does, say, a 5x. So it moves from 16K to, say, 90K, 100K. Now your 10% allocation is suddenly 60%, or maybe a bit less because other asset classes go up as well. So you move from 10% to a much higher fraction of your net worth being in Bitcoin. Now, do you want to be that massively in Bitcoin after the rally? Probably not. The first reason is that the future returns after such a rally are probably not going to be as high. So after a 5x, we're probably not going to see another 5x soonly thereafter. The second reason is if you started with a 10% allocation, you probably feel more comfortable with 10 or 20% allocation in general. You don't want to have suddenly half of your money in BTC, especially if it can drop by 60, 70, 80% after a rally, potentially. And so that's why this metric here is so useful. It's the net unrealized profit and loss. And when the market in aggregate has a lot of net unrealized profit, that's when people tend to take some of that profit, right? When we are in the red area, people take profit, people rebalance their portfolio. They don't want to have 60, 70% of their net worth in Bitcoin, especially if you're starting out with only 10%. But then we want to buy when most people are in losses, right? When the net unrealized loss is in the green area, that's when selling pressure tends to slow down. Now, why does selling pressure slow down whenever the market in aggregate is in losses? It's because Bitcoin over the very long term tends to appreciate because its supply doesn't expand as quickly as fiat. For long term, we should expect Bitcoin to go up. Thus, if we're currently in losses, we might just wait it out. It's same with property, right? If you buy a house and suddenly your house is in the losses, you are less inclined to sell that house and realize the losses. You're just waiting it out until the prices go up again. A very similar mechanism can be seen with Bitcoin. And so we just oscillate between losses and gains, losses and gains. And it might make sense to sell whenever we are close to the euphoria greed area. We are not there right now. We are, of course, in net profit because we're close to the all-time high in Bitcoin, but we are not, relatively speaking, in percent returns for the entire market at similar levels to where we had been when Bitcoin was at 50K, for example, right? When it moved from 3.5 to 50K. So the market is not as heated now, even though the price is close to all-time highs. We can also split this up by cohort. So now we see the long-term holder net unrealized profit and loss. That's now in blue. We want to buy whenever even long-term holders are in losses, and we want to sell when the long-term holders are in massive profit. We can also adjust this for volatility. So we look at the net unrealized profit and losses relative to how much the market tends to go up and down. And again, there are somewhat predictable bottoms and predictable tops. Personally, I like to sell whenever I see other long-term holders selling. So when the value days destroyed metric is going up. So value days destroyed is measuring what is the dormant Bitcoin doing. If you hold, say, 10 Bitcoin and you don't move them for an entire year, and after 1 year you're moving them, then you're destroying 10 value years. If you have only 1 Bitcoin and you move it after 1 day, you're destroying 1 value day. So the longer the Bitcoin had been dormant and the more Bitcoin suddenly starts to move, the higher this indicator is going. So the whales, the diamond hands, when they suddenly wake up, we might get closer to at least a local bottom. So they sold when Bitcoin was at 40K. Yes, we did see a bit more of a rally, but then afterwards we went down to 16K. They also sold massively at 72K. Again, we continued to go up a bit further. But those kinds of points, I believe, are good opportunities to again rebalance. If you're buying heavily when the market is in net unrealized losses, when you're buying at 20K and at 16K, and then the long-term holder starts selling at 70K, it might make sense to sell as well, partially. You made your 5x and you started with 10% allocation, which turned into 50. Why not put this back down to 10 and realize the gains and move this into something that's not so correlated, like gold, for example. Now let's zoom out a little bit and have a look at the macro picture. We actually see an expanding crypto market, money flowing into the market since October of 2023 already. We know this because of this data over here, the stablecoin market cap. It's currently going up. Before October of 2023, it tended to go down. And the way this data is generated by looking at the minting and the redemption of stablecoin. So fundamentally how this works is when you deposit your hard-earned fiat currency to a centralized exchange, then that centralized exchange will send over the fiat currency to a custodian, to a stablecoin issuer. That custodian, so be it USDC, so Circle, or Tether for USDT, that custodian will hold the funds in a dedicated account and then will create tokens. So that's what's happening when this chart is going up. Whenever you're withdrawing your funds, then of course the custodian has to release again the fiat, send it over to you via the centralized exchange, and that's when we go down. And there's a reasonable case to be made that the more money is in a system, the higher the prices should go. Have a look at this. This is Bitcoin since October of 2023. And the largest drawdown we have seen while money was still flowing into the market was 28%. But again, when money is flowing in, those dips tend to get bought up. Now, what are those green circles over here? They appear after a price rally. It's an indication when there's a lot of attention on crypto. So there was a spike in search interest for Bitcoin at the beginning of March of 2024, but also at the beginning, middle of November of 2024. So that's what's highlighted with those bubbles. The masses tend to be late. The masses tend to buy after a price rally. And that's a problem, right? Most people enter crypto when prices are high and then potentially comes at least a short-term correction. And then a lot of those people that got excited about Bitcoin first have to ride through that correction. It can be minor, since currently the market still expands, but it can also be major, of course, as we have seen with prior attention spikes. And so there are two fundamental forces that move the crypto prices. First of all, it's the money in and outflows, but it's also the swapping activity. So once there's capital in the system, people tend to swap in and out of Bitcoin, but also in and out of the altcoins. And whenever we deploy, say, $100 worth of stable coins, the market cap of a crypto asset rises more than that. There is some inherent leverage effect. And that means we can measure how much the market is currently risk on or risk off. What we've got over here is the stablecoin dominance. So it's not the stablecoin market cap, it's the stablecoin dominance. It measures how much of the entire cryptocurrency market cap is currently in stablecoins. When this is very high, the market is risk off. So a lot of the market cap is in stablecoins. When this is very low, the market is very risk on. And in the last 1.5 years, we tended to trade in a range between 5% stablecoin dominance and 9% stablecoin dominance. And surprise, surprise, when the stablecoin dominance is high, it means crypto prices are very low. When the stablecoin dominance is low, crypto prices tend to be high. So interestingly enough, whenever the stablecoin dominance is low and when prices have already gone up, that's when the tourists enter and first get burned. So we want to be counter-cyclical. We want to sell when stablecoin dominance is low. We want to buy when stablecoin dominance is high. And it very much looks like we are currently on the way to seeing more stablecoin deployments. In other words, the current positive rally is probably going to continue. I don't have a crystal ball. It's just the way how I interpret the data. And then the question is, does it make sense to just buy Bitcoin if we expect prices to go up, or should we rather go with the altcoins? Now, some altcoins can do phenomenally. Others tend to underperform. But let's have a look at, for example, Virtual. Virtual went up by almost 3x in the last month. But I think it's better to try to find those altcoins very early. So the real gains had been made in the early days, right? When we look at the all-time chart of Virtual Protocol, those gains are immense, 20,000%. And so the life-changing money is not necessarily just in riding the current wave and buying a broad basket of altcoins. It's trying to find approaches to get into those altcoins much earlier than most. And I think a very good approach is to look at people that tended to buy well-performing assets early in the past. So for example here, right, this is Brian Young. He bought the Virtual Protocol token at 7 cents. And that was on the 21st of March 2024. So that's over here. We subsequently saw a rally of more than 6,000%. And so here's his YouTube channel, right? He's got more than 2 million subscribers. It of course begs the question, is Brian Young just more skilled, or does he have sufficient impact on the prices? Because maybe some of his following is buying into the token as well. I don't know, but it's always valuable to know what those kind of people are doing. The way how we knew about Brian Young buying into the token at that time was not because he announced it that early on his channel. It was because we track his wallets. We've got 5 of Brian Young's wallets. In total, we track almost 600 influencer wallets. So we've got also wallets by Alex Becker. He's got 1.6 million subscribers. We are also tracking the Crypto Banter channel. They've got 1.2 million subscribers. And again, I think it makes sense to be very early with the insiders and with the people that move the market. Now, of course, not every single token that's purchased by an influencer is going to rally. Some tokens are just bought and never announced on the social media, so we don't have the purchases by the following. But if you want to have a chance of being early, if you want to get the 10 or 20x returns, we can't just buy what's already big, right? We have to buy the things that the smart money is buying as well. And so here are a few examples of trades that our community has made. We discuss the influencer trades. We discuss potential opportunities to bet on rising, but also to bet on falling prices, depending on market conditions. And so, of course, we track our influencer wallets, but there's also a tutorial section on just just how to find those influencer wallets. There are various approaches through NFTs, through related transactions, through deposit addresses on centralized exchanges. There are 8 tutorial videos in total. And so then the community is trying to figure out what wallets that we are not yet tracking can we potentially add to our bot. So there's a dedicated wallet research chat. We've just added influencer Chicken Genius. And then every day we get signals when influencers buy and sell. Selling is also important, right? Most people don't publish when they sell. It's very interesting. Some people just buy, publish a video on an asset, and then sell just a few hours afterwards. They're literally pumping and dumping on the audience. It's quite nice to look behind the scenes. And so feel free to check it out. It's down below. It's thebitcoinstrader.com. Currently the price is $125 per month. It went down because search interest in crypto is now rather low. Once we are up again, the price of course will get increased, but not for the people that are already subscribed. So once you sign up for $125, that price is locked in. So here's my recommendation. Don't wait until attention is again at those heights. We are still early. The market is expanding though. Macro is positive, but you don't want to wait until the rally has already happened. Right now, attention is still low. The rally is likely going to continue. As said, there's still money on the sidelines. The stablecoin dominance has room to further fall, which will result in rising altcoin prices. It's just about figuring out what altcoin has most upside. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. The link is down below, thebitcoinstrader.com. There should also be a link directly here on the screen where you click on that link, then it will lead you directly to the page. See you next time. Bye-bye.